FORA.tv. The world is thinking.
As the dollar falls and the euro strengthens, what do you think will be the impact in the world money markets, and is the euro going to replace the dollar as the currency of choice?
The euro is already replacing the dollar as the currency of choice. OPEC and Japan and China are diversifying their sovereign holdings, and individual investors are diversifying their holdings into euro-denominated assets. That is wise. The equivalent of the Federal Reserve Board chair in China announced that policy for his government over a year ago. It's already happening. When President Reagan and Speaker Tip O'Neill were dealing with each other, and as a result, we increased spending faster than revenue, and the deficit grew. It was financed by OPEC, and in those days Japan, who had no place else to put their money. The U.S. Treasury bond was the safest long-term investment for OPEC. Euro-denominated bonds now compete, at least compete, with the U.S. dollar-denominated sovereign debt. And so it's already happening. A basket, at the least, I think, is where OPEC will be going for their investments. Impact of that, interest rates will rise. Long-term interest rates will rise in the United States. It has to happen because the demand is increasing. How much is the demand increasing? The amount of the deficit every year, and it just got $150 billion bigger. So what is the deficit expected this year, including the stimulus package? $594 billion, half a trillion. That's increased demand. Half a trillion increased demand over and above what we're already borrowing. If Europe and OPEC does not continue to supply that demand, prices have to go up. That's what happens when demand for a good increases and the supply does not. The good in this question is money, and the price of the good is interest rates. So it's a pretty straightforward economic proposition that long-term interest rates going up is the inevitable consequence of the switch away from the dollar as the international store of value towards the euro.
As you look at the dollar and its implications on our trade positions, what do you see as the flow of goods and the changes in our economic markets that will be happening over the next couple of years?
First of all, the overwhelming effect is a good one. Whatever we make and pay our workers in dollars will fetch a higher rate of return in euros or pounds as the dollar continues to decline, or the yen relative to those other currencies. So that means we increase our competitive posture. We become more competitive compared with other nations' production. And that's a good thing. And it's been a long time since trade has been a positive flow. But remember in the text of my remarks how much I showed the positive side of trade. Shifting, though, the law of comparative advantage has not been repealed, and that means that America will be increasing our sale of exports, but it will be those in which we have a comparative advantage, which is capital intensive, not labor intensive. Interestingly, American agriculture is capital intensive. Some people think that it's labor intensive because they have this notion of agriculture being the husbandman with a scythe. No, the output per worker in agriculture is substantially higher than any of our competitors in the world. It is a capital-intensive area. So exports will continue, be faster because of the declining dollar, but will continue to be capital-intensive.